Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look at the September jobs report in the U.S., what it could mean to Fed policy moving forward. I'm Tom Busby in New York.
I'm Caroline Hepker in London, where we're asking if France's new government can navigate an uncertain political road ahead.
I'm Doug Krisner, previewing Chinese consumer behavior during the Golden Week holiday.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with a look at the September jobs report here in the U.S. Non-farm payroll numbers come out this Friday, 8:30 a.m. Wall Street time. What could those numbers mean for Fed monetary policy moving forward? Well, for more, we're joined by Stuart Paul, U.S. economist with Bloomberg Economics. Well, Stuart, no doubt we've seen some softening in the U.S. labor market, but we still see growth. What are you expecting to see this coming Friday?
The consensus estimate is for 130,000 jobs. That's what folks are expecting was added in September. That's a little bit lower than the estimate for August, which showed 142,000 jobs added. We think risk is actually skewed to the upside for that non-farm payroll number, and it could be as high as double what the consensus estimate is. But that comes from our tracking of high-frequency data, which shows that there were fewer layoffs in the hospitality and entertainment industries in September, and hiring was way above the seasonal norm in education. Now, that could just be a little bit of catch-up from a weak August when it comes to hiring in education. So we think that even if we do see an upside surprise, the Fed can read through it a little bit. And I just want to layer on one additional complication there. We know that monthly estimates for non-farm payrolls are running a bit high because of mismeasurement issues at the Bureau of Labor Statistics. We know that we're going to get a downward revision, and it's our best estimate that we're still seeing monthly non-farm payroll estimates that are about 90,000 jobs per month overestimated. So we know that even if we do see an upside surprise, you got to discount it for that mismeasurement problem. And even if we were to see something like, let's say, 250,000 jobs added, it's really more like 160,000. If we do see the consensus estimate of 130,000 jobs added, it's really more like 40 to 50,000 jobs added. Under either scenario, that's hiring that's still too slow to maintain a consistent unemployment rate. So we do see unemployment rate risk as skewed a little bit to the upside.
Well, right now the unemployment rate is 4.2%. Or where could it go? Would it stay the same?
So we think that 4.2 is a reasonably good estimate. Risk is skewed toward 4.3%. We have a precise but very knife edge estimate of 4.25%. So it really comes down to the rounding at the Bureau of Labor Statistics. If we're thinking about the trajectory of the unemployment rate, though, where could it be at year end, and how might the Fed respond to that in November and December when the FOMC meets for the next couple times? We think that the unemployment rate can end the year at about 4.5%. We're still seeing that hiring that's just too slow to maintain a consistent unemployment rate. And when that's the case, the Fed is going to be inclined to cut a bit more. Again, even if we see that upside surprise in payroll numbers.
Well, that sounds like a pretty big upside surprise that you're talking about. Doubling, perhaps, the 130 estimated. What's behind these, I won't say miscalculations, but the big difference in these estimates?
So part of it comes down to how the Bureau of Labor Statistics extrapolates an estimate for nationwide hiring from a rather narrow sample of businesses that are surveyed. There's still couple 100,000 businesses that are surveyed every month, but compare that to the tens of millions of businesses that are operating in the United States, it's still just a very narrow slice. The BLS has to have a model for how it can extrapolate from the survey to the broader economy. We've seen time and time again both revisions on a monthly basis and downward revisions based on that improper extrapolation from the narrow
that
survey.
818,000. Yeah.
That's exactly right. So through the first quarter, in the year ending in March of this year, March of 2024, we know that payrolls were overestimated by about 818,000 jobs. So we know that we have that revision coming, and we think that since then, we're running at a pace of about 90,000 jobs per month overestimated. So that helps to resolve this puzzle that we deal with, which is we see hiring that seems to be pretty stable and robust, but we still see this unemployment rate that's rising. And if that's the case, we need to square the circle. I think that part of it is an overestimate of hiring plus layer in immigration. And we know that just the current labor supply is not being fully absorbed. Just demand is not entirely sufficient to keep that unemployment rate steady.
Well, for a Fed that says it's data dependent, this must be pretty vexing for them.
It is. It's the sort of thing that's troubling. It's the sort of this is part of the reason why the Fed has so many economists on staff to help solve these questions. But I think that one thing that's clear is that with cooling inflation, the Fed can focus its energies a bit more on achieving the maximum employment objective within its dual mandate. And I think that that's why we're going to see a Fed that's still on its rate cutting course, because when you have labor supply that's outstripping demand, you're going to have that rising unemployment rate, and you should see the Fed respond with additional rate cuts.
Well, the September jobs report from the Bureau of Labor Statistics out this Friday. And our thanks to Stuart Paul, U.S. economist with Bloomberg Economics. We move now to politics with just over a month to go ahead of the U.S. general election. Vice presidential nominees, Republican Senator J.D. Vance of Ohio, Democratic Governor Tim Walz of Minnesota will debate this Tuesday, facing off for the only time ahead of that November 5th vote. Bloomberg Television and Radio will have special coverage and a global simulcast of the CBS News debate starting Tuesday at 8 p.m. Wall Street time. Now, for more on the debate and the economic visions of both vice presidential candidates, we're joined by Laura Davison, Bloomberg Politics editor. Laura, thank you so much for joining us. I'm going to start with, what are you looking forward to hear from both vice presidential candidates this week?
So this debate is really going to be different than some previous VP debates that we've had. One, in that there's just more interest in both of these figures. Both of them, obviously have been on the political scene for a little bit, but have, not necessarily had a quite the same national profile. J.D. Vance coming sort of into the world of politics from being an author in his book Hillbilly Elegy. Walz, more low profile. He was a member of the House from a rural Minnesota district and governor of Minnesota, but didn't quite have the same national profile. But what's interesting is they both have a very much an economic populist message, but what that looks like is very different. Vance has spoken a lot about big tech and the need to break up big tech in ways that he almost sounds like a Democrat. But in other things that he talks about in terms of taxes and other things, he's more in line with the mainstream of where the Republican Party now is. Walz, as governor, has spent a lot of time thinking about what we kind of call the care economy. So things like child care, preschool lunches, child tax credit. He spent a lot of time thinking about, how can, the government implement policies to make life easier for families.
Well, he certainly has a record of, that $1.9 billion Jobs and Projects Act. Like you said, the state established paid sick and medical leave, banning non-compete agreements. So he has, let's face it, a better track record. We can see what he has done. But let's compare him and Vance in some things. Let's start with a hot button issue right now. We are facing a devastating strike right now in Seattle at Boeing. What about unions? Let's start with Vance on unions and then about Walz.
Yeah, so this is kind of one of those areas. They both talk about the American worker. This is something that they're both, sort of central to their messaging. Vance and Trump, of course, have also been less favorable towards unions. Trump recently, in a conversation with Elon Musk, even sort of talked about firing workers for striking. And so this is sort of a position that Vance has adopted as well, and is less favorable towards unions, and basically sort of wants people to have a little bit more freedom. Of course, both sides are very much courting the union vote, and they both tout that. The Teamsters just recently declined to endorse either ticket. And so both sides have sort of been taking that as a win, saying, hey, look, this is, we have the working man on the side of us.
But a lot of state Teamsters, though, have come out, right, in favor of Harris-Walz.
Yes, one of the reasons that the Teamsters didn't endorse it, they put out this polling saying, "Look, our membership is very split. Upwards of 50%. I think it was 58, 59% of the Teamsters actually said they wanted to endorse Trump. Only about 40% wanted to endorse Harris. But of course, the Teamsters have long endorsed Democrats, so they decided to just stay out of this fight. But at the local level, you've seen both Vance, Trump, Harris, and Walz campaigning with Teamsters members from specific states. Walz was with Teamsters members from Arizona, and Harris has also been with Teamsters from some of those blue wall, Michigan, Pennsylvania, and Wisconsin areas.
Now let's talk taxes. Walz has raised taxes on wealthy earners, a 1% surtax, capital gains, dividends, investments topping $1 million a year. He also raised corporate taxes. They're the highest in the U.S., 9.8%. However, some giant corporations based there, 3M, General Mills, Cargill, Target, U.S. Bank, just to name a few, are staying there. So is it working, those taxes on corporations? And what's Vance's, view on that?
Yes, the general Walz philosophy, and this is something that Harris also adopts, is that, you raise taxes on corporations, on the wealthy, to pay for tax benefits for lower earners and middle income earners. So that's what you saw play out in Minnesota when he was governor, that he raised taxes on the wealthy, raised that corporate tax, to a level that, corporations still said, okay, it still makes sense for me to keep my business based in Minnesota, not so high that they would leave. But then you can use that money to expand the child tax credit, to pay for, paid leave, to pay for school lunches and some of these things. So that's sort of like the basically what the Harris vision is to do on a national level, what Tim Walz has done, broadly speaking, in Minnesota. Vance has a very different view about taxation. He has also proposed tax cuts for lower earners, particularly a big increase to the child tax credit. That's been something that he's been very vocal about on the campaign trail. This is something that also that Walz and Harris want to do, but they have different approaches in how they would do it. Basically, Vance wants to give this tax credit sort of regardless of income status, whereas Walz wants to target this more just to sort of lower and middle income earners so that they would get the biggest benefit. When it comes to corporate taxes for Vance, he is not in favor of increasing those. It's actually a big goal for Trump and for the Republican ticket to lower corporate taxes. It's something to talk about on the campaign trail a lot. Trump, during his first term, lowered the federal corporate rate. It was at 35%. He lowered it down to 21%, so a really big jump. Trump has been talking about wanting to lower that down to 15%. So that's something that is sort of a big gap between the two parties' tickets, and something that you'll probably hear about on the debate stage on Tuesday.
Well, there's a lot to look forward to. That debate this Tuesday, October 1st, and our thanks to Laura Davison, Bloomberg Politics Editor. A reminder, Bloomberg Television and Radio will have special coverage and a global simulcast of the CBS News debate starting Tuesday at 8 p.m. Wall Street time. Coming up on Bloomberg Daybreak Weekend, we'll look at whether France's new government can navigate an uncertain political road ahead. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in the program, a look at what China's Golden Week means to the Chinese economy. But first, France has chosen its new government with a 73-year-old statesman, Michel Barnier, as prime minister. But this comes as an EU budget deadline looms and the country awaits policy announcements. We should get a first look at his plans this week, but can the former Brexit negotiator quiet the political turmoil in Paris? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, in the next few days, we're expecting to hear from the new French Prime Minister Michel Barnier in an important speech. His new cabinet has only just been created after a record-long 2-month transition period that politically paralysed France. It has been described by one veteran commentator as the most right-wing cabinet in more than a decade. More broadly, concerns about France's finances are also growing. Rattled investors have resumed selling the country's bonds. And so, in short, Michel Barnier is under a great deal of pressure in terms of political stability, popularity and economics. Recently, lawmakers have had to warn that the budget deficit has widened much more than expected, and politicians have pledged tough action to ensure credibility in the face of the bond markets. Maria Jacot from Edmond de Rothschild Asset Management in France says lawmakers are now under significant pressure to deliver a solution.
The issue is that fiscal policies and decisions have clearly not been at the heart of President Macron's consultations in the recent past. So the government is really going to have to work under huge time pressure. And it's at this point of time very difficult to say what sort of measures they are going to come up with. But one thing is sure is that it's the absolute priority for this government, and they have very little time to implement. So what it means is that he's going to be able to get anything done. He's going to have to, at the bare minimum, get the abstention from some of the non-affiliated deputies or LIOT, for example, if not the active support from some of the extreme right deputies in Parliament. Otherwise, he's going to have to use the 49.3 over and over again, and then he risks a vote of no confidence. And then, nothing is going to get done, really.
So it all seems like a very scary and a very kind of frustrating and intense situation that doesn't necessarily yield positive results given the time crunch. But on the positive side, if I may inject some happiness here, is that Michel Barnier is a skilled diplomat. He is a skilled negotiator. So I think the logic from some has been that he can actually manage the division that you're seeing in Parliament. The other side of it is that from the EU side, there may actually be concessions to the French government if this deficit doesn't quite match their standards. Does that change your view on France and the investability of France, given the cushion that they may get from the EU and given the global confidence that perhaps is growing in this pick?
That would certainly be helpful. And when you look at how the markets have reacted so far, and French equities, for example, you see that the French stocks that were purely domestic ones have actually already recovered from the losses from the snap election time. And we have to remember that 85% of the MSCI France and the CAC is actually driven by stocks that are global stocks and have a global exposure. So I think that's their volatility and the way they behave is actually quite independent from French politics. Our position at the moment is that we've taken profits from European equities and we're neutral. We're more interested in emerging markets. In the equity space, but also in the credit space. And that's really because of, the recent announcement of the easing policy by the Fed. And we believe that it will, help get flows into emerging markets who have actually weathered the inflation crisis pretty well. So we're quite excited about, that part and that region, if I may, serve equities
so
Europe.
So your interest is elsewhere, and is that because you think that there are risks that we just do all this again in a year? We go into further parliamentary elections in a year or so, Marie. Is that one of the reasons why you look elsewhere? Because we could see volatility or even negativity attached to politics in Europe.
It's one of the reasons, definitely. And if we go from, vote of no confidence that the government doesn't survive, then, it's very likely that it will happen. But I think the other argument is independent of this, and it's really linked to the worries around European growth. And more generally, when you look at growth in developed markets, recent year and then expected for the years to come, it's more around, 1.6, 1.8%, whether, you look at, emerging markets, you're around 4%. So the risk of recession is also lower in emerging markets than developed markets at the moment.
That was Maria Jacot there from Edmond de Rothschild Asset Management France. She was speaking to my colleagues Kriti Gupta and Anna Edwards on Bloomberg Television. So, Barnier is the oldest premier in the history of the French Republic. So will his experience be enough to see him through France's political storm? It's something I've been discussing with Bloomberg's Caroline Conan, our reporter in Paris.
It took 2 months for President Macron to name a new prime minister, Michel Barnier, since the second round of the snap elections on July 7. And then it took another 2 weeks for Michel Barnier to actually form his government. In the end, he unveiled it over the last weekend. You've got 40 ministers, half men, half women, with most of them coming from the center and from Macron's ranks, the Renaissance Party, a few from the Republicans, which is Michel Barnier's party, and just one from the center-left, the Justice Minister, Didier Migaud. One surprising thing I could say about this new government is that it doesn't really include a lot of heavyweights, apart from maybe Bruno Retailleau, who was the leader of the Republicans in the Senate and is now Interior Minister.
So Michel Barnier is due to give a big policy speech then in the coming days. Why is that going to be so important?
So the reason it's very important is because it could trigger or not the first vote of no confidence against this Barnier government. We know, of course, this government is very fragile given there is no majority in parliament. And already this week, you've seen a lot of controversies, for example, with the new finance minister, Antoine Armand, who said the national rally was not part of the so-called Republican front. The problem, as you know, is that the national rally has become kind of the kingmaker in parliament, because if they do support any motion of censure, then the government can collapse. So Michel Barnier had to call Marine Le Pen personally to reassure her, and Antoine Armand then sent an email saying that indeed all the parties, including the national rally, will be invited to the finance ministry to discuss the state of public finances. So there was a lot of backpedaling here, and you can see that any comment in the political debate could actually backfire against the Barnier government.
So lots of tricky issues then for Barnier. But in all of this, what does the public want to hear from Michel Barnier?
Probably not that austerity measures are coming, and yet that's probably what's coming, given the deficit, according to the budget minister, could actually rise to more than 6% of GDP this year. Then the right-wing electorate, of course, is also keen to hear more about new measures to control immigration. The left wing wants more social justice, and most of the French would actually like Barnier to abandon the pension reform, which passed last year and raised the retirement age to 64 years old. But that's unlikely, given Barnier needs to do some savings in the budget, and he's already said he'll only make a few adjustments to the pension reform.
Barnier is new to his role as Prime Minister, but obviously is an old hand in terms of politics. What has he said so far, though, about his priorities in this role?
Well, he keeps repeating that he's going to tell the truth, even if the truth is difficult to hear, meaning that even if there is some austerity measures in the short term, these are necessary. He's repeated that the budget situation is very serious. He's also said he wants to fight against social fraud, those who take advantage perhaps of the welfare state when they shouldn't. Another of his priorities, again, is to fight illegal immigration, but he's also tried to reassure the left wing on some social laws such as abortion and gay marriage, saying he's not going to touch any of this.
One of the other priorities is going to be the budget. France has got to submit a draft copy to the EU by mid-October. What are the main sticking points with that issue?
Again, the deficit could slip to as much as 6% or even more this year, when the initial forecast was 5.1%. So some savings will definitely be needed, according to the Banque de France governor. As much as 100 billion euros of savings are actually needed to bring the deficit back to the 3% target within 5 years. So that could be around 20 billion a year at least of spending cuts, without even taking into account the increase of spending that we saw from local authorities, for example, this year. So Barnier has already said that he could increase some taxes for multinationals, for the wealthiest individuals. A few areas are being explored, for example, increasing the 30% flat tax on capital, which was, of course, one of the key measures of Emmanuel Macron. There's also discussions of an exceptional tax on super profits of some multinationals, or perhaps a tax on share buybacks, and also of course, a targeted income tax for the wealthiest individuals.
Well, speaking of President Emmanuel Macron, what is the relationship like between Barnier and Macron? How will Barnier's difficult decisions, as you laid them out, affect Macron, his popularity, his standing as president?
Well, it's quite interesting because, of course, Emmanuel Macron has a very low popularity, especially since the snap elections. About 25% of the French currently think that Macron is a good president, and that's the lowest popularity he's ever had since his first elections in 2017, 7 years ago. Initially, when Michel Barnier was named, there was kind of a nomination effect. So the first polls were showing that he had 57% of positive opinion, but the state of grace actually didn't last very long. And there's another recent poll by Odoxa that says that 59% of the French think that Barnier is not a good prime minister, and many are skeptical about his capacity to actually pass a budget. But that's also mainly because the French think that President Macron is actually holding the reins in the back.
My thanks there to Bloomberg's Caroline Conant in France. So we look ahead to Michel Barnier and a tricky speech to deliver in the next few days. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, a look ahead to what China's Golden Week will mean to the Chinese economy. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. This year, the People's Republic of China will celebrate its 75th anniversary. This week, the country celebrates its annual Golden Week, travel holidays, and this Tuesday, it's National Day in China. For more on what all that means to the Chinese economy, we turn to Bloomberg Daybreak Asia co-host Doug Krisner.
Tom, the holiday may provide the first test as to whether consumers will respond to this blitz of economic stimulus that was unveiled last week. Several key interest rates are being lowered. The level of required bank capital is being reduced, so more lending is feasible. And there will be support for both the housing and equity markets. This plan, I think it's fair to say, is aggressive and comprehensive. And on top of that, in a highly unusual move, the government will provide one-off cash handouts within the coming week to disadvantaged groups, including orphans and those in extreme poverty. Now, for a closer look at what we may see in Chinese consumer behavior during the Golden Week holiday, I'm joined by John Liu, Bloomberg executive editor in Beijing, and Katya Dmitrieva, who is Bloomberg Asia economics correspondent in Hong Kong. Thanks to both of you for joining. John, since you're in the capital city, let me begin with you. One of the critical issues, I think it's fair to say, that's holding back a lot of domestic recovery is this sentiment problem, particularly where consumers are involved. And I'm wondering, from your perspective, how that's distributed across the country.
I think there's a big difference between the really big cities, your mega cities like Beijing and Shanghai and Shenzhen, and smaller towns and the countryside. And that's just a reflection of the fact that there's a lot more wealth in Beijing, Shanghai, and Shenzhen than there is in the countryside. And in any economic downturn, it's always sort of the people at the top that feel it the least and the people at the bottom that feel it the most.
Katya, is the elephant in the room the property market? I think are you going to tell me yes?
Yes, I am. Yes, the property sector is still the number one issue. It's so much more so in China than in other countries. Just looking at the data, I mean, 90% of Chinese people own their homes. You've got more than 70% of household wealth that's tied up in properties. It's quite different from other parts of the world where a lot more people rent. They're not as exposed to the property sector. So as long as you have weakness there, as long as you still have prices falling, the demand is just not going to come back. And the stimulus package addressed that on the margin. But, even having a lower down payment for a second home, I mean, if your first home is still below the value it was pre-pandemic and it's not clear when it'll go back up, you probably aren't going to be motivated to spend that much more.
John, interest rates in China have been low for quite some time, and we're talking about, very, very small adjustments to the downside, and yet those lower rates really haven't reinvigorated the economy. And we have seen kind of a deflationary spiral, which I would imagine has been very, very troubling to authorities in Beijing. How are people impacted when they see this protracted period of inflation? How is it showing up anecdotally?
I think the trend that we've seen is people have focused much more, households and corporates, much more on paying down their debt than we have people borrowing to make additional purchases, to make new investments, to build a factory, etc. And I think it was maybe 2 months ago, we had the first time in a long time where bank lending actually contracted on a monthly basis. And so you're seeing people are doing whatever they can to pay down the debt. And so that I think is a reflection of uncertainty about the future, about future earnings, about their future economic outlook. And that is what's keeping people from spending, and I think why more people are saving as opposed to borrowing.
The savings point, I think, is very interesting. I spoke earlier with Piqian Liu, who is Asia economist at Fidelity International, and one of the things that I wanted to get her take on was the indicators that we should be watching to understand the health of the Chinese consumer.
So firstly, the consumer confidence index, I think everybody knew that the pandemic has hard hit the household sector, and consumer confidence index has been coming down sharply. But at this moment, on the path of recovery, we have actually seen consumer sentiment stabilizing at low levels. So they are not rebounding sharply, neither did they deteriorate significantly from where we are right now. I think the underlying reason for that is perhaps because the divergent pattern of the consumption that's been emerging from both the wealth impact from property sector, as well as some of the consumers might have been hurt by the employment pressure as well as income growth. So overall, I think another indicator we're also watching out for closely is the PBOC's depositor survey. On that survey, we see divergence between depositors' preference over saving, consumption, and investment. We have observed wider divergence between saving and investment. But surprisingly, I think the consumption is more or less stabilizing, even though at still moderate levels, but they are on a gradual recovery pattern right now.
She is Piqian Liu from Fidelity International. Katya, let me go to you next. Is there anything that the government can do to encourage people to release money from their savings accounts and put that money to work in the economy?
Yeah, there are a few things. I mean, we talked about the property sector. I think more guarantees would certainly help, just to see those prices start to rise and consumer sentiment start to improve a bit. We also didn't even mention the job sector. We didn't even talk about unemployment and the labor market, where unemployment for youth is at an all-time high this year, even after the government made some revisions to that data set. So the jobs market, if you're going to work and of course not getting bonuses, let alone job cuts or getting your pay cut, that's also one big factor here as well, because if the money is not coming in, you are also feeling a little less likely to spend, especially on holidays, during holidays, when we see in China a couple key holidays each year when there's lots of time off, and people tend to travel quite a bit and make those big item purchases for the year. So there are certain big things. I think the stimulus package was one of them, was one way for the government to say, okay, we acknowledge that things are getting a little rocky here. Which had been a question for economists for some time, is whether the government even knew about how bad the situation was or wanted to address it. So this is at least an improvement in sentiment. The next thing they have to do is perhaps more targeted, could do targeted stimulus. I've heard from economists in terms of fiscal stimulus, similar to what they've done during the pandemic. But it really does come back to, at the end of the day, the property sector, and the property sector improvement, kind of like chicken and egg with a lot of these companies. You have an improvement in the property sector, consumers are happier, companies are starting to invest more, hire more. It's sort of that good virtuous cycle.
John, I'm recalling a program that some referred to as kind of cash for clunkers. Do you remember that, where people were being given some sort of incentive to trade up in home appliances? Was that very effective?
They've been trying to do that. They did it during the financial crisis back in 2008. They've rolled it out this year. We've seen some limited take up. I think the criticism I've heard most about that plan is that what it really does is it brings forward purchases. So people who are going to get a new refrigerator anyway, people who are going to get a new car anyway, now they're going to do it now instead of waiting 3 or 4 or 5 months. It's not really generating new demand, because if you didn't have the money to begin with to get a new refrigerator, getting 10% or 15% back probably is not going to change your decision making on that.
Katya, in the context of the Golden Week holiday, I think of spending on discretionary items. Jewelry is in there. I also think of travel. Do we have any indication that the appetite now is at a level where it may move the needle?
Consumer sentiment is near all-time lows in China right now. And it is tough to get a gauge. Aside from that, in terms of how consumers are feeling, we can see on social media, for example. That's why we write so much more about social media sentiment in China than other countries. And there's this term that is going around called the garbage economy. And that's something that's been a couple, almost a year now, where people online have been talking about this current period as sort of the worst. The silver lining, of course, is that it can't get any worse. But the idea there is that, people are just not in a good mood to spend. During the May Day holiday this year, we did see a bit of a pickup compared to last year, kind of a mixed picture. But this upcoming holiday is one of the bigger ones in China. And so places that I'll be looking for, in addition to the indicators that were mentioned, is travel spending. So plane tickets, train tickets, buses. We're seeing this trend of people just traveling more locally. So less travel abroad to places like Thailand, Malaysia, South Korea, a lot more internal travel. But it would be interesting to see if there is more international travel at this time of year. There's also a lot more purchases of, think of like food or clothing, those kind of smaller items. We could hear from potentially executives commenting on that, or during the next quarter, which I know is a bit of time to wait for. But yeah, there's a couple places to look.
John, I referred to the fact that in the last week, the government announced that it will provide some one-off cash handouts to disadvantaged groups. Has this happened in the past? And talk to me a little bit about the symbolism and how that may resonate across the broader economy.
This sort of handout is pretty rare. The government does give sort of cash handouts to disadvantaged groups ahead of the Lunar New Year festival every year. And they have in the past. Before, we're coming up on the National Day holiday, so this is celebrating the founding of the People's Republic. They have in the past given sort of cash out to World War II veterans ahead of this holiday. This is relatively rare that they would, in this instance, give cash out to lower income earning brackets at this time. That is fairly unusual. They are also offering assistance to college graduates who have not found a job in 2 years. That is unusual as well. There's been a big debate here in Beijing among policymakers about whether giving cash directly to the consumer would actually do any good. The sort of argument against it is that because the savings rate is so high, a lot of people might just take that money and save it and not spend it. And so I think this seems to show a greater willingness to try new things out.
John, we'll leave it there. Thank you so much for making time to chat with us. John Liu, Bloomberg Executive Editor in Beijing. And thanks as well to Katya Dmitrieva, who is Bloomberg's Asia economics correspondent. She's joining us from Hong Kong, helping us understand what we may see in the week ahead as we approach Golden Week and the Chinese consumer. I'm Doug Krisner, and you can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.